Firstly, let's define what REITs and traditional real estate investing are. REITs are companies that own or finance income-producing real estate properties. Traditional real estate investing involves purchasing physical properties and managing them yourself or through a property manager. Both options have their advantages and disadvantages. REITs are generally considered to be a more hands-off option, as you don't have to deal with the day-to-day management of properties. They also offer more liquidity, as they can be bought and sold on public exchanges like stocks. However, they may not offer as high returns as traditional real estate investing and may be subject to market volatility. On the other hand, traditional real estate investing allows for greater control over the properties and potentially higher returns. However, it requires more time and effort to manage the properties, and can be less liquid than REITs. When it comes to tax implications, REITs are required to distribute at least 90% of their taxable income to shareholders in the form of dividends, which can be taxed at a lower rate than traditional income tax. Traditional real estate investing allows for tax deductions on expenses such as mortgage interest, property taxes, and repairs. In terms of risk, both options have their own set of risks. REITs are subject to market volatility and fluctuations in interest rates, while traditional real estate investing is subject to property-specific risks such as natural disasters or changes in local real estate markets. Ultimately, the best option for generating passive income depends on your individual preferences, risk tolerance, and investment goals. It's important to do your own research and consult with a financial advisor before making any investment decisions. In conclusion, both REITs and traditional real estate investing can be viable options for generating passive income. Each option has its own advantages and disadvantages, and it's important to weigh them carefully before making an investment decision. With the right strategy and mindset, either option can be a valuable addition to your investment portfolio.